In 1929, stocks fell 89%. In 2008, they fell 57%. Both changed history. Yet, according to current data, 2025 to 2026 is set up to be more severe than both. This is happening to your savings, your retirement, your future, right now. Because for the first time in modern history, stocks, housing, and government bonds are all dangerously overvalued together. In past crashes, one asset always survived. In 1929, bonds held. In 2008, government debt saved banks. This time, all three pillars are stressed at once, with no obvious safe harbor for capital anywhere. Start with stocks. The S&P 500 trades around 28 times earnings, versus a normal range of 15 to 17. We have only seen valuations this stretched twice before, in 1929 before the Great Depression, and in 2000 before .com. Both times, markets reversed within months. Both times, investors explained away the warning as a new era narrative. But 2025 adds something new. 7 megacap companies now represent roughly 30% of the entire stock index. If those few leaders stumble, index funds, pensions, and retirement accounts tied to them all move down together. One company alone trades above 65 times earnings, with a market value larger than some entire advanced economies. AI enthusiasm today mirrors the internet mania of 1999. The technology is real, the pricing is not. And this time, leverage hides in options, structured products, and corporate borrowing, layered on top of stretched valuations. This is happening to your 401k, your index fund, your tech stocks, whether or not you pay attention. The second bubble is housing. Residential prices sit roughly 50% above long-term norms versus incomes and rents. At the peak in 2006, that gap was around 35%. Today, the overvaluation is roughly 43% larger. Because prices have been high for so long, many people no longer recognize this as a bubble at all. Behind the scenes, commercial real estate faces even tougher math, with offices in major cities sitting partially empty. Buildings financed at 3% interest now must refinance at 7 to 9%, even as rental income weakens. When loans cannot be rolled over, owners hand properties back to lenders, and regional banks absorb the losses. The third bubble is the one that makes 2025 truly unique, the bubble in government bonds themselves. Federal debt now exceeds $36 trillion, about 125% of the country's entire annual economic output. Annual interest alone runs above $1.2 trillion, larger than spending on defense or social programs individually. So policymakers face three bad options: cut spending, raise taxes, or create new money and risk higher inflation. Put together, we have stocks priced for perfection, housing priced beyond incomes, and bonds weighed down by immense debt. The exact same pattern that destroyed wealth in 1929 and 2008 is forming again across every major asset class. In 1929, stock valuations reached unprecedented extremes, with earnings multiples in the 30s just before the downturn began. People believed electricity, radio, and automobiles had rewritten economic rules. In 2025, artificial intelligence plays the same psychological role. In both eras, households and professionals borrowed heavily to buy stocks, convinced rising prices made leverage permanently safe. Wealth inequality was extreme in 1929, with a small elite controlling a disproportionate share of total income. Today, wealth concentration is even higher, with the top 1% controlling roughly a third of all assets. But unlike 1929, when only about 10% of households owned stocks, today around 58% are exposed. Deposit insurance exists now, but the insurance fund covers only a fraction of total deposits in the banking system. In 2008, the trouble began with subprime mortgages, complex securities, and banks leveraged 30 to 1 against falling home prices. Today, the same lending standards appear in auto loans, credit cards, student debt, and highly indebted corporations. On top of that, the derivatives market has swelled above $600 trillion of notional exposure, tying institutions together. In 2008, central bankers could cut interest rates from over 5% to zero and expand their balance sheet dramatically. By 2025, interest rates are already relatively low, and the balance sheet already swollen from years of quantitative easing. Government debt has also doubled as a share of the economy since 2008, leaving little room for another rescue. This is happening to your government, your taxes, your currency, whether or not anyone talks about it openly. At the same time, major trading partners face their own property slumps, aging populations, and energy constraints, limiting global rescue capacity. One of the most reliable warning signals, the yield curve, already flashed and then returned to normal in 2024. Historically, recessions begin 3 to 12 months after that normalization, not during the inversion itself. Meanwhile, credit card balances exceed $1.14 trillion, with interest rates over 20% and delinquencies climbing. Over $2 trillion of commercial mortgages come due in 2025 and 2026, many tied to struggling office buildings. Regional bank failures in 2023 and 2024 were early hints of how sensitive balance sheets are to rate shocks. With the so-called Magnificent Seven now making up roughly 30% of the index, market leadership has never been narrower. Executives are selling their own shares at record pace, while famous value investors quietly accumulate hundreds of billions in cash. Unemployment has already risen from 3.4% to over 4%, enough to trigger the Somme rule recession signal. Auto loan delinquencies are the highest since 2009, with average monthly payments near record levels and very long terms. Student debt exceeds $1.7 trillion, and delinquency rates have risen since payment pauses ended after the health crisis. This is happening to your paycheck, your rent, your degree, your car payment, every single month. On top of this, wars and tensions around the world keep energy markets and supply chains on edge. Large property owners have already walked away from some office towers, signaling that refinancing math no longer works at current rates. The exact trigger almost does not matter: an earnings miss, a policy surprise, or an unexpected corporate failure. What matters is how selling cascades through algorithms, margin calls, and risk models once confidence breaks at the top. Within weeks, stocks can fall 30 to 40% as retail selling, forced sales, and institutional rules all interact. Historically, investors would flee into government bonds, but heavy new issuance can now push those prices down as well. Housing markets then seize up, with few buyers at old prices and sellers reluctant to recognize new lower values. As more commercial borrowers hand back keys, regional banks must mark down loans, eroding their capital buffers. If multiple banks fail quickly, the insurance fund depletes, and authorities must decide whether to create new money to protect deposits. In the real economy, companies respond by cutting costs, slowing hiring, and eventually reducing staff as revenues shrink. Unemployment can move into the mid-teens, with young workers and lower-income households feeling the impact the most. For someone with $600,000 saved, a 70% decline means falling to around $200,000. This affects your retirement, your ability to stop working your expected standard of living in old age. Graduates entering the workforce during deep recessions often earn less for decades than similar students who finished earlier. Small businesses struggle as sales weaken and credit tightens, while large firms with stronger balance sheets gain relative power. Public safety nets come under pressure as tax revenues fall, just as demands for assistance rise sharply. History shows that prolonged economic stress often reshapes politics, as frustrated citizens look for simple answers to complex problems. So 2025 combines the stock overvaluation of 1929, the credit excesses of 2008, and unprecedented government debt. Nobody explains that. This time, the safety valves that saved the system before are already fully used. Based on the yield curve and refinancing schedule, the highest risk window runs from late 2025 through late 2026. In that period, stocks could fall 65 to 80%, housing 40 to 60%, and bonds over a third. The everything bubble means there is nowhere to hide, only a choice between being surprised or being prepared.